And welcome to the SARS fiscal year 2023 year-end close training. My name is Rob Hamilton. I'm the Statewide Accounting and Reporting Services Manager. The live version of the training that we did on Wednesday, June 21st, we tried to do a recording. However, the internet went down and our recording did not complete successfully. We only got about the first 16 minutes. As a result, we are all re-recording these after the fact on Teams. As a result, I think you're probably going to see our pictures or our initials to the right of the screen. We're not really going to have an opportunity for questions. It might feel a little bit disjointed, but I hope that you'll bear with us as we cover the topics that we did during the year-end close training. Here's the agenda that we're going to cover today. I'll be running through what's new from SARS, followed by a year-end schedule with Bree DeLacy. After that will be a budgetary reporting at the end of the biennium with Sherry Keller, followed by considerations when accounting for federal awards with Alyssa Engelson. From there, we'll go to changes in CFA submissions with Karen Williams, followed by a quick recap of GASB 87 with Valia Rizzo. And then we'll move on to some highlights that of GASB 94 and 96 related to the training that we did in May with Brady Stutzman. I'll be back and covering things about what's coming from the GASB. And then we'll move on to disclosure changes and common deficiencies with Barbara Homewood. And then I'll wrap things up with a summary and some key takeaways. So what's new from SARS? Really, it's the team. We've had quite a few changes over these last couple of years. I'm going to run through who we've got. You can see in parentheses the month and year and when those folks had started in their current positions. And you can tell that we've got a lot of folks that are from the last couple of years. For the Senior Financial Reporting and Policy Analyst, we have Brady Stutzman. For our Senior Accounting Analyst, we have Barbara Homewood, Valia Rizzo, Alyssa Engelson, and Kathy Watson. From our Accounting Analysts, we have Sherry Keller, Heather Klein, and Bree DeLacy. And then a relatively new position that we have is our Statewide Financial Compliance Analyst, and that is Karen Williams. She's actually been in the SARS team since about 2007 in a variety of capacities. And part of her new role will be to be the point person for all things federal that runs through SARS, whether that's the CFA, the Single Audit Report, Subrecipient Monitoring, the SWICAP, the CMIA. She also will be involved with system security policy, statewide travel policy, and then some statewide accounts receivable management. What is not new from SARS? And that is our commitment to helping agencies be successful with their accounting and year-end reporting responsibilities. We recognize that fiscal year 22 is really hard on everybody, and we are very invested in seeing this upcoming fiscal year end be successful for all that are, for us and for agencies. And I think we have a great team that will help agencies be successful in that end. And so if you have questions, please do not hesitate to reach out. Some changes to debt issuance accounting in SFMA that I wanted to cover, specifically related to DAS issued debt. When DAS receives, or going forward with the change from US Bank to Key Bank, DAS is going to receive all bond proceeds and then send them to the issuing agencies via a balance transfer. We've created a new comp object 1120, titled the Bond Clearing Account, which is where agencies will receive the BT from DAS. And then they will use that to clear out their entries related to the bond issuance. So at the end of their transactions, comp object 1120 should be 0. And again, this will apply to all bond issuances that DAS is involved with, whether it's a general obligation bond or a lottery revenue bond. This was a process that we employed for the most recent lottery revenue bond. For those agencies that were part of that, they have been notified of this process. And again, this is going to be the process going forward. To that end, we'll have some changes to the OEM, which we'll reflect in the OEM as quickly as we can. Also wanted to thank Liz Schultz and Minnie Fernandez. Both were extremely helpful. Were very involved with getting this new process in place. So thank you to them. Every once in a while, we have some questions that come up around who should I ask around an accounting question? Is it our SARS analyst or is it our SFMS analyst? I wanted to address that. If you've got a question about what is GAAP for a given situation, what should the transaction ultimately look like? Your best resource is going to be your SARS analyst. If you want to know how to best use the system, how to enter a transaction in the system, or how do we get to that endpoint, that's your SFMS analyst. The ECFR contacts list has both of them in the link that's been provided. And when you are working with both your SARS and SFMS analyst on a specific accounting issue, please make sure that each knows the other is involved. It's really important to know that our SFMS analyst is also involved in the conversation when we're working with them, and likewise, I think on their side. So just making sure that we're both sides are in the loop, and it's going to make the conversation much more efficient and effective for everyone. Obviously, since we're doing a recording, there's really not an opportunity for questions, but this completes my portion of the what's new for SARS, and then we'll move on to the year-end schedule with Bree DeLacy.
My name is Bree DeLacy, and I have the privilege of going over the year-end schedule for Act for Preparation items for 2023 fiscal year. I realized that I have one of the more boring sections of this, so I've made it visually stimulating for your viewing pleasure. In this section, we are going to be going over important deadlines, our STARS timeline, or really quick review of month 12 and month 13, OB and where to find specific reports in the repository, statewide balancing reports, some month 13 resources, and just a handful of helpful links in case you're not sure where to find the links themselves or need a place to be directed. So the first thing we'll be going over is important deadlines. The first deadline that's coming up is for this specific training. It needs to be watched by June 30th for anyone that isn't at the training. So if you're here, you're doing it, don't leave. If you are not at the training itself, then this video and recording of this will need to be watched by June 30th in order to maintain your gold star status. The next deadline coming up is July 14th, which is the official close of month 12. Year end officially begins on July 14th. The next deadline after that is July 26th, where your first communication with any discretely presented component units needs to happen regarding any verification of outstanding balances. This isn't a gold star date, but it should be happening if applicable. Next is August 4th, which is the soft close for month 13. This is the target for all year-end adjustments, and this is also the target date to utilize any interagency transfers, any statewide balancing reports, and ensuring that working with another agency that you have all of your entries in by this date, and reviewing any correspondence with your SARS analyst in case one of the SARS analysts has instructed to do an adjusting entry by this date so that there's time for review and ensuring everything looks correct. Once it's posted, this gives you a week to do any minor touch-ups as necessary, but also gives other agencies time to do their side of the entries if, you know, it's a two-agency item. It's a great way to make friends. The next deadline after that is the second communication with your DPCUs. This is when you should have your second and final verification of outstanding balances with any discretely presented component units like OHSU and any state universities. Again, this is not a gold star deadline, but it should be happening. After that is the official gold star date and close of month 13. Any and all necessary accounting entries should be completed and correct unless written pre-approval for post-close entries is received from SARS. After that, August 18th, another gold star deadline is for your agency and CFA disclosures to be submitted to SARS. So you want to get those into us timely to maintain your gold star status. This is the day to do it. Now that we've gone through important deadlines, the next thing is our STARS timeline and what that looks like, just the span of month 12, month 13, really briefly. Hey, look, it's our STARS. So for month 12, that spans from June 19th to July 14th. This officially closes on July 14th, and starting Monday, July 17th, a full report run will be available for year-end reporting. For month 13, July 17th through August 11th, agencies can request various R-Stars reports, which would become available each following Wednesday morning. All right, now that we have gone through that, the next portion is where to find some repository reports in OB. This is for the people who haven't completely dived into this yet, but just really brief on how to get there quick and easy. So this is for the DAFR 6610, 6620 reports. So once you log into OB, you're going to want to come over here to the catalog button right there in the top right. And then once you click catalog, you'll be able to see this portion where you're going to want to click shared folders right there. Excuse me. After you click shared folders, you're going to want to click on repository, which will be the final folder at the very bottom, which will lead you into another subset of folders right here, where you'll want to click on final. And once you click on final, you will see the two options of reports for the DAFR 6610 and 6620, as well as the CFA reports. This is where to find the specific repository reports that we often mention. So just to take a quick look at the dashboard for the DAFR 6610 and 6620, there are 6 total reports. This is what's going to show up on your screen once you get through them. So the top 2 reports, 6610 being your operating statement for the month. It lists the last closed month totals and compares it to the prior year. Will be the top 2 for 6620 being your balance sheet reports on the dashboard for DAFR. The next 2 reports down will be for period 13, specifically, the cumulative period 13 style of report to show the full year. This also compares to the prior year, so 6610 being your operating statement and 6620 being your balance sheet. And last but not least, we have the year-end specific period 13. This is only available during the span of month 13. Otherwise, there will be no data shown due to the tables that are used to pull the data from. And these, along with the period 13 reports, are what will be utilized for year-end reporting. So next, we're going to go over table updates and year-end reporting timing. So the tables that affect both the monthly reports as well as period 13 specific are these general SFMS tables. These tables during the month of 13 will be updated starting Friday evening and available each Monday morning. They include the GL detail, GL summary, and GL all accounting event. And then the year-end specific tables, these ones, there's 2 separate timelines, so that's why I have them separated out. The year-end GL detail and year-end GL summary will be updated every Wednesday, Friday, and Monday morning during month 13, starting on July 17th. And the year-end active accounting event table will be updated every Wednesday and Friday during month 13. So these, depending on if you have your own separate queries built, these are when these tables are updated in order to go through all of your reports. The next item is the statewide balancing of statewide balancing reports. And this is found on the SARS website. So the statewide balancing reports are something that are produced by SARS and uploaded to our website. So, over on the left side, you'll see a little gray square here, and in bold in the middle, statewide balancing reports is selected there, and that is what you would click if you can maneuver your way to our SARS report in order to get to this page and see all of the different types of reports. The box on the top right in blue shows you when this was updated and how recent the data was pulled from SFMS or Datamart or OB. The reports available are advances to and from other funds, due to and from other funds, indirect transfers, interagency transfers, and operating transfers. And all of these reports have both two different options. They have the full report detail, including everything in balance and everything out of balance, and then they have the exception only, so you can see specifically the ones that are out of balance. And then month 13, resources is what's next. So this is a handful of places you can look if you're not sure where you're going to go in order to finish month 13, or start something in month 13, try to handle a situation that may have come up. If you need a direction and where to look, these are our resources. So we have the agency guide to year-end closing that is available on the SARS website. We specifically recommend this checklist in section D10 for month 13 year-end closing. We also have OB analyses. Either you can build your own or use something that has already been provided. Our SARS reports are a great source for seeing what's on the system, seeing how it's been posted. Statewide balancing reports on the SARS website as well. Great tool to see, things that are in balance and ironing those out if they're out of balance. Any prior year closing entries and disclosures, if you're newer to the agency or want to see how something else was handled, potentially looking at the prior year data can be super helpful. Also, we recommend Chapter 15 of the OAM for year-end and accounting reporting. It's a great resource for any procedural or policy regarding how items should be handled. And last but not least, your friendly neighborhood SARS and SFMS analyst. Last but not least, we have helpful links here. And this is just for your use to be able to access to any of these websites if you didn't have them already bookmarked. So we have the SARS website specifically, agency gold star criteria, schedule of key dates, statewide balancing reports, as well as for SFMS, we have the SFMS calendar, SFMS report guide if you need to understand a field on any of the reports. We have the OB website and the OB frequently asked questions and table directory, so that if you wanted to build your own query or had any questions as to what field was what, this is the great place to go to figure that out. And that concludes my portion of the slides and presentation. Thank you for bearing with me through this very short and very dull portion of the presentation, but I'm glad you stuck with it. And next we have Sherry with budgetary reporting.
Welcome everyone, I'm Sherry Keller. Today I'll be presenting applying budgetary policies at the end of the biennium. Since the start of the biennium only happens every 2 years, we wanted to provide a refresher. The difference between generally accepted accounting principles and budgetary accounting policies become very apparent when transitioning from one biennium to another. My goal today is to provide you with the tools necessary to answer the question, can I still record this transaction in the 21-23 biennium? Here's a summary of the topics I'll cover today regarding budgetary policies: general fund revenue and receivables, interfund transfers with the general fund, expenditures, encumbrances, and commitments. Let's start out by looking at the difference between a fiscal year and an appropriation year. A fiscal year begins each July 1st and runs through the following June 30th every year, and is identified by the calendar year in which it ends. Generally accepted accounting principles provide the basis to determine which fiscal year a transaction should be recognized. The appropriation year begins on July 1st of an odd number year and continues until June 30th of the following odd number year. It is also identified by the calendar year in which it ends. For this presentation, I'm only talking about budgetary general fund, which represents appropriation funds that begin with the number 8. For the budgetary general fund revenue, revenue is recognized in the appropriation year in which the cash is received. There is no accrual of revenues in the general fund for budgetary purposes. This is strictly cash basis, with the possible exception of some entries of the Department of Revenue or for capital construction. However, for reporting purposes, an accrual will take place. We will see examples of this in the slides to follow. These budgetary guidelines do not apply to all fund types, only the general fund. These rules are critical because of the calculation done to determine if the general fund revenue is sufficient to trigger a kicker. Revenue recognition for federal, lottery, and other funds are not addressed in the budgetary chapter of the OAM. Here's an example. An agency received general fund revenue on July 5th for an amount owed to the state on June 30th. For this scenario, the timing crosses both the fiscal year and the appropriation year. For budgetary reporting purposes, this revenue is recorded in AY 25. However, for financial reporting purposes, this would be considered revenue in fiscal year 23 and should be accrued. For financial reporting requirements, accrue the revenue in month 13, fiscal year 23, AY 23. This entry will automatically reverse in month 1 of fiscal year 24. As a result of these entries, revenue is recognized in fiscal year 23 in accordance with GAAP, and there is a 0 net impact to revenue for annual appropriation year 23. For budgetary purposes, record the general fund cash in month 1, fiscal year 24, AY 25. The auto reversal is recorded in fiscal year 24, and thus there's a 0 net impact to revenue. If you have document-supported general fund receivables that will not be collected by June 30th, you'll need to move them to the new biennium. Non-document supported receivables do not need to be moved. Let's look at an example to see why it's necessary to move the receivables. Let's say in AY 23, you recorded an entry which recognized revenue that you now know will not be received in AY 23. The following steps will show how to move the general fund accounts receivable forward to the new biennium. First, you will need to reverse the accounts receivable that was established previously in month 12, fiscal year 23, AY 23. Next, in month 13, FY 23, AY 23, accrue the receivable for financial reporting purposes. This entry will automatically reverse with the system-generated entry. Next, reestablish the document-supported accounts receivable in the new biennium, month 1, fiscal year 24, AY 25. This effectively moves the document-supported general fund accounts receivable forward to the new biennium. Finally, when revenue is collected, record cash revenue and liquidate the accounts receivable in fiscal year 24, AY 25. After all the transactions are done, you will have accrued revenue reported in fiscal year 23. The auto reversal will result in a 0 net effect to the revenue in AY 23. A document supported accounts receivable that is moved to AY 23 fiscal year from AY 23 to AY 25. And finally, general fund cash revenue that will be reported in AY25. In the event it is necessary to record a reduction of revenue, first determine if the biennium is open or closed. If the biennium is open, record the reduction of revenue in the same appropriation year as the original revenue was posted. If the biennium is closed, it will have to be recorded as an expenditure. And remember, this is true for all appropriated fund types, not just the general fund. If you have an interfund transfer that involves a transfer to or from the general fund, it must be recognized in the appropriation year the cash is moved. If cash is moved July 1st or later, it must be recorded in the new biennium. Both sides of the transaction, both the to and the from, must be recorded in the same biennium by both agencies or both funds. Let's look at an example. Agency A collects general fund revenue on June 29th, but does not transfer the money to Agency B until July 6th. Agency A would record general fund revenue in month 12, fiscal year 23, AY23. Because the transfer did not occur until July 6th, Agency A will also record a general fund transfer out to Agency B in month 1, fiscal year 24, AY25. Agency B will record a general fund transfer in from A in month 1, 24, fiscal year 24, AY25. For financial reporting purposes, an entry by each agency is also needed to accrue the general fund transfer in month 13, AY23, fiscal year 23. This accrual will be offset by an auto reversal, which will also post to AY23, resulting in a net zero effect to interfund transfers for AY23. Now let's look at the entries. Agency A accrues the transfer out to Agency B, and Agency B accrues the transfer in from Agency A in month 13, AY23, FY23. Remember, a transfer of expenditures using T codes 415 and 416 is not an interfund transfer. Rather, it's a movement of expenditures and cash from the fund where the original expenditure was paid to a more appropriate fund within the agency. The movement of expenditures must be recorded in the same appropriation year and the same fiscal year as the original expenditure. For example, on June 28th, the general fund at your agency paid for expenditures that are actually an other fund budget item. On July 24th, which is after the close of June in SFMA, the expenditure is moved from the general fund to the other fund's budget. Since the gap fund for the two D23 funds is not the same, the agency must record entries to move expenditures in month 1, fiscal year 24, AY23 for budgetary purposes, and accrue the movement of expenditures in month 13, fiscal year 23 for financial reporting purposes. To record this movement of expenditures, use T code 415 in the other fund in AY23 and T code 416 in the general fund, also in AY23. The debits and credits cancel each other out, but the expenditure is now appropriately reported in other fund in AY23, the year of the budgeted expenditure, and just as important, the appropriation year of the original expenditure. Record an entry in the other fund and in the general fund in month 13, FY23, AY23, to move the expenditure and recognize it due to and a due from between the funds. Now let's talk about expenditure recognition. As a reminder, this applies to all budgetary fund types. In order to change obligations against appropriation year 23, the services must be performed or supplies received by June 30th, and the vendor must be paid by December 31st, 2023. Encumbrances are defined in OAM Chapter 20 as a formal commitment to purchase goods or services within the current biennium. Encumbrances are 1, an obligation that is recorded as a liability, and 2, there is an intention to liquidate the liability with financial resources of the current biennium. Even if there's a signed contract for goods or services, but by June 30th, the contract has not been fulfilled, the encumbrance is no longer valid for AY23. You will not be able to charge any more expenditures to the 21-23 biennium. You will need to review all your outstanding encumbrances. For those that are no longer valid, record entries to eliminate them for financial reporting. For goods or services received by June 30th, liquidate the encumbrance and record a liability. For goods or services not received by June 30th, either cancel or eliminate and move the encumbrance to the new biennium and disclose a commitment. In the event you determine there are invalid encumbrances, eliminate them for financial reporting purposes with T code 931R. This will auto reverse in month 1, fiscal year 24. Later, if the encumbrance is still outstanding, the encumbrance canceling program will permanently remove it in December. If you determine that goods or services have been received by June 30th and you have received an invoice, during month 13th, you will record an entry to accrue the payable using T code 220. The effect of the transaction will be that an expenditure is accrued for fiscal year 23, AY23, with an offsetting liability. The encumbrance will be liquidated and removed from the appropriation table. If the goods or services are received by June 30th, but the invoice has not been received by the end of month 13, the obligation becomes a liability, recorded in accounts payable accrual in month 13 using T code 437. However, do not remove the document supported encumbrance. Instead, record an additional entry for financial reporting purposes to eliminate the encumbrance. This additional entry will offset the document supported encumbrance that was initially recorded. In month 1 of fiscal year 24, the system will auto reverse both entries and post them to AY23, the appropriation year the initial entries were recorded. The effect of these transactions are the obligation is recorded as an accrued expenditure in fiscal year 23, AY23, and with an offsetting liability. For financial reporting purposes, the encumbrance for the obligation is eliminated for fiscal year 23. For budgetary purposes, the document supported encumbrance is still on the books as an AY23 encumbrance. Assume the invoice for goods or services received by June 30th finally arrives in September, and payment is made September 16th. At this point, month 13th has already closed and has month 1 and 2 of fiscal year 24. Record the entry using T code 225 in fiscal year 24. However, since the goods or services were received by June 30th, it will still be recorded in AY 23. Our SARS generates T code 380 to liquidate the voucher payable when the warrant is issued. In this case, month 3, fiscal year 24, AY 23. The effects of the transactions are the cash expenditures recorded in fiscal year 24, AY 23, then offset by the automatic reversal of the accrued expenditure, and the documented supported encumbrance is liquidated. The last scenario is where the goods or services are not received by June 30th. As I mentioned, there are 2 options to address this issue for financial reporting purposes. You can eliminate or cancel the encumbrance. However, if your agency is still planning on making the purchase of goods or services, an entry will be necessary to reestablish the encumbrance in the following biennium. The effects of these transactions are the documented supported encumbrance is removed from AY 23 and reestablished in AY 25. The commitment needs to be reported in your disclosures. So what is a commitment? Commitments represent obligations related to unperformed agreements that are not encumbered. They are not expected to be paid within the current fiscal resources. They are not reported in the financial statements as a liability, but they are disclosed in the notes. For fiscal year 23, report commitments for goods ordered or services contracted for that have not been fulfilled by June 30th. When they are received, they will be paid for out of AY 25 budget. Generally, commitments are long-term contracts or agreements associated with grants, loans, leases, and/or capital construction. An obligation can be either an encumbrance or a commitment, but not both. Do not duplicate. This especially applies to the first year of the biennium when encumbrances do not need to be eliminated. There is further information about commitments and encumbrances in the OAM, or if your situation is not clear, please call your SARS analyst for assistance. As a reminder, if you're using balance type 33 grant commitments to track your grant activity, please be sure to record those commitments in your disclosures. A reduction of expenditures is used only in special circumstances as defined in the OAM. This includes, but is not limited to, refunds for overpayments, purchase rebates, job rotations, reimbursement for hosting special events, or insurance recoveries, to name a few. Remember, the reduction may not exceed the actual expense and must occur in the same appropriation year as the original expenditure. If the expenditure is made from the general fund and the AY is closed, talk to your SFMS analyst on the steps needed to revert the money to the general fund. For additional information about budgetary accounting reporting, please refer to OAM Chapter 20. A link to the chapter is available at the bottom of the slide. If you have any questions, feel free to contact your SARS analyst.
Hello, my name is Alyssa Ingleson, and I have the privilege of presenting on considerations with accounting for federal awards. With such an uptick in federal awards these last few years, We hope the next few slides help provide some key considerations to contemplate as we head into year end. First, I'd like to talk about advanced grants. Per OAM 15.42.00, an advanced grant can be defined as when an agency requests funds from the federal agency before incurring expenditures. To record the receipt of funds from the federal agency, you would start by debiting cash and crediting unearned revenue. This is key as it is important to recognize revenue for cash received up front. I have a question you can consider when reviewing your balances at year end. Does your agency have an advanced grant that is sitting in unearned revenue? If the answer is yes, it's important to ensure that the ending balance at fiscal year end reflects the cumulative amount unexpended, not the amount that was received from the federal agency. For instance, during the first year, if an agency received $1 million as part of an advanced grant, but only had $100,000 in expenses that met the eligibility requirement, then the fiscal year ending balance of unearned revenue should be $900,000. It's also important to note that the communication between program staff and accounting is very important. If all the money from an advanced grant has not been spent come year end, accounting will need to make some adjustments to unearned revenue accordingly. I'd like to mention that a great example of an advanced grant would be the State and Local Fiscal Recovery Fund, also known as SLFRF. For an expenditure-driven grants, it's important to remember that revenues will need to equal expenditures. Continuing with advanced grants, let's talk about materiality and the movement of funds. There is a $20 million materiality threshold when moving any federal money between gap funds or between agencies. This materiality threshold is applied to the amount sent and is at the assistance listing number level, formally referred to as the CFTA number. The goal of this materiality threshold is to treat the transaction as if the prime agency or fund never had the money. When moving funds between gap funds and agencies, the prime agency would use a T-code 113 and then either a T-code 119 if the movement of federal awards was recorded as a distribution to state agencies, or a T-code 125 if the movement was recorded with a transfer out. The secondary agency that is receiving the movement of the federal awards would record a T-code 124 and then a T-code 113R. These entries are important as they keep revenue and expenditures in the same gap fund, which is a requirement from GAAP. It's important to note that the guidance above does not supersede the rules on eligibility. Here you'll see the coveted General Disclosure G, government mandated or voluntary non-exchange transactions. Why is this disclosure coveted, you may ask? Well, if it's month 13 and your agency doesn't have an unearned revenue recorded for an advanced grant, you may complete General Disclosure G. Completing this disclosure will result in an approved post-close adjustment. That's right, a post-close adjustment that doesn't affect Gold Star status. Now let's chat more about what questions to complete on the disclosure. If you are an agency that is a recipient of a non-exchange transaction, you would complete questions 1 through 3 on the disclosure. If you are a provider of non-exchange transactions, you would complete questions 4 through 6 on the disclosure. By completing this disclosure, we at SARS will be able to make an adjustment in the ACFR to ensure that amounts received or provided as part of a non-exchange transaction are presented correctly. Don't forget about this disclosure. Even if it hasn't been a disclosure you've completed in the past, it may be worthwhile to review and complete in the current year. Moving on, let's talk about purpose-restricted grants. While these are not common across the enterprise, we thought we'd provide a few considerations for you in the event your agency has any. For purpose-restricted grants, the key difference from other types of grants is that there is generally no requirement to return the unspent or unexpended money received from a federal agency. The revenue received would be considered restricted revenue as long as all of the eligibility requirements are met. Finally, we'd like to provide some considerations for FEMA reimbursements. We anticipate an uptick in FEMA reimbursements coming soon, so our hope is the following considerations will be helpful once those FEMA reimbursements we've all been patiently waiting for arrive. Per assistance listing number 97.036, FEMA Disaster Assistance, an agency should record FEMA reimbursement activity when the reimbursement is received, not when occur. This guidance derives from some grantees experiencing long delays from the time they incur the expenditure to the date that they are approved to receive the federal relief funding. For expenditures related to assistant listing number 97.036, if an agency were to receive a FEMA reimbursement in FY23 for amounts expended in previous fiscal years, they would need to complete and send in a CFA corrections form. On the CFA corrections form, the agency would identify all of the prior year expenditures that were deemed eligible for the FEMA reimbursement received in FY23. The correction form is needed as our CFA repository wouldn't have these prior year expenditures included. Next, let's discuss some reminders and resources. If your agency is spending American Rescue Plan Act, also known as ARPA, funds, not just SLRF funds, a new D23 fund must be set up with a State Fund Group 2124. Other State Fund Groups examples include State Fund Group 2020 for CARES Act activity and State Fund Group 3000 for activity relating to the Coronavirus Response and Relief Supplemental Appropriations Act, also known as CRRSAA. The State Fund Group 3000 for CRRSAA is fairly narrow in scope and will only apply to a few agencies. Finally, a great OAM resource on all things federal grants is OAM 15.42.00, which can be found on our SARS website. If there are any questions, please don't hesitate to reach out to your SARS analyst.
Karen Williams, and I'm here to talk about the changes in CFA submissions and the disclosures. Why are we doing this? Well, in part, it's been a little while since we've made any changes. And also, we wanted to add clarity to what agencies are expected to submit. So here's a picture of the previous year's transmittal of disclosures and agency certification. And some agencies seem to be confused on what amounts were supposed to be recorded on this page. So we've done away with it. So this is the new version, and we've removed the need to record amounts. Instead, we've added checkboxes to identify all forms submitted with the certification. This form is currently in Excel format, so please convert to PDF before sending to your SARS analyst. So there were no significant changes to the checklist or disclosure 1, so we're skipping ahead to disclosure 2. And with amounts being removed from the certification, we needed to make sure that everything was included here on the reconciliation page. So we've added indirect expenditures as shown with yellow highlight. A reminder that your debit and credit indicators should match your DataMart repository reports. If any corrections are needed for the CFA information, please submit them on the CFA corrections worksheet. So there were also no changes to disclosure 3 or disclosure 4. However, if an agency completed disclosure 4, they were also responsible for submitting the Federal Non-Cash Assistance Workbook, which was a separate document. Instead of keeping it as a separate document, I've added the tabs to the disclosure itself so that everything is in one spot. So in the past, we've received some inconsistent information from agencies. So we've beefed up the CFA corrections template to address this and to format information as it's needed for federal reporting. If changes are needed to CFA information, please use the current corrections template and not a spreadsheet corrected at the agency. Go ahead and keep that for your records, but please feel free to copy and paste from your spreadsheet to the corrections template. We just ask that you please use paste values to avoid introducing formulas to the corrections spreadsheet. So this is a top portion of an expenditure correction sheet. This is what I see mostly coming in. So a key has been added to the top of the page to provide state fund group numbers. And we do ask that you use the number and not the acronym when completing the spreadsheet. Go ahead and add rows as needed, but please maintain the layout and formatting as otherwise presented. And that includes not adding extra columns or extra tabs. There's a SARS column to the right that we ask that you please leave as is. It's added here to avoid having to add it to each individual page as it comes in. Don't feel like you have to drag the formula down to match the number of rows you have. I'll take care of that when it comes in. So this is the bottom portion of the same expenditure page to allow a closer look at some of the columns. All requested information is needed for accurate reporting. For each correction an agency reports, SARS actually enters it twice. First, to remove the original entry exactly as entered into the system, and the second time to enter the correct and complete information. As such, we ask that you please do not net corrections. So in wrapping up, we're requesting the OB repository reports be submitted as a single Excel workbook with tabs for each report. For corrections, the use of the state fund group number as opposed to the acronym. So for an example, if you have an ARPA correction, you would enter 2124 on the spreadsheet. Provide subrecipient tax ID number as opposed to the SFMA vendor number or the unique entity identity number. Revenue corrections require the grantor ID and the grantor name. This is both for direct revenue and indirect revenue. And as a last item, I would like to make a plea to please make sure subrecipient information is fully populated in the system before the close of month 13 in order to not have avoidable corrections needing to be submitted later.
Hello, and welcome to the GASB 87 Leases Recap portion of the Year-End Close training with your host, Valerie Rizzo. Overview for today, we're going to go over the lease definition, the lease term, and the non-cancelable periods. Then we're going to go over new leases for fiscal year 23 for agencies that didn't have any in the last fiscal year. For agencies that implemented in fiscal year 22, this is the second year, which might require lease remeasurement, modifications, or terminations of a lease. Lastly, we're going to go over some resources that agencies can use for GASB 87. A quick reminder of what a lease is. It's a contract that conveys control of the right to use another entity's asset for a period of time in an exchange or an exchange-like transaction. Some common examples include office spaces, buildings, vehicles, and equipment like Ricoh printers. The lease term is the period the lessee has a non-cancelable right to use the asset, as well as the periods they're reasonably certain they will exercise to extend or not exercise to terminate the lease. Remember, exercising one of these existing options is subject to the guidance for lease remeasurement, which we'll discuss a little bit later. So agencies that will be entering leases in fiscal year 23, we want to make sure they're recording them in the proper gap funds. So following the suggested entries at lease commencement, you can record steps 1 and 2 in either a governmental fund, a proprietary fund, or a fiduciary fund. Note, steps 1 and 2 should not be recorded in the government-wide reporting fund, GAP Fund 8500. Steps 3 and 4, establishing the lease liability and the leased asset, should only be done in either a proprietary fund, fiduciary fund, or in the government-wide reporting fund, GAP Fund 8500. And we know this because we know that capital assets and long-term liabilities should not be recorded in governmental funds. For fiscal year 23 and beyond, agencies making their lease payments out of Gap Fund 0001 who cannot record revenue items in that Gap Fund. A new D23 fund in Gap Fund 0054 needs to be set up to record steps 1 and 2 there. If you're not sure, a quick way to check is checking your DAFR 6610 report and seeing if you have any revenue posted to the General Fund 0001. For year 2 of implementation, a few things to consider are lease remeasurement, modifications, lease terminations, and ending a lease at the end of the lease period. The lessee should remeasure the lease liability if there was a change in either of the items listed below, and the change or changes are expected to significantly affect the amount of the lease liability since the last measurement. The question becomes, what does your agency consider significant? Now, this is not a threshold, just an example, but let's say you measured the liability and the change is $100,000. SARS would consider this not significant and would advise not to spend the time making the adjustments. Now let's say the change is 30 million. This would be a significant change and we would ask you to make those adjustments. Again, these are only examples and not a threshold you should follow, as each agency is different and it also depends on which gap fund you're operating out of. If you're not sure, you may want to reach out to your SARS analyst. The lessor should measure the lease receivable if one of the or more of these changes happen during the reporting period based on the most recent lease contract before the change, and the changes individually or in aggregate are expected to significantly affect the amount of the lease receivable since the previous measurement. For lease modifications, amendments can modify a lease contract. Some examples of amendments include the following: changing the contract price and lengthening or shortening the lease term. An amendment should be considered a lease modification unless the lessee's right to use the underlying asset decreases, in which case the amendment should be considered a partial or full lease termination. If an amendment occurs which results in a modification to the lease contract, the lessee and lessor should account for this modification as a separate lease only if both of the following conditions are present. If both conditions are not present, this does not apply to you. Lessee should account for a lease modification by remeasuring the lease liability. The leased asset should be adjusted by the difference between the remeasured liability and the liability immediately before the lease modification. Reminder, modifications are increases to the leased asset. A lessor should account for a lease modification by remeasuring the lease receivable. The deferred inflow of resources should be adjusted by the difference between the remeasured receivable and the receivable immediately before the lease modification. If the change relates to payments for the current period, the change should be recognized as an inflow of resources, example revenue, or an outflow of resources, expense, for the current period. Lessees and lessors should account for an amendment that results in a decrease in the lessee's right to use the leased asset as a partial or full lease termination. Some examples of things that may cause a decrease in the asset are: the lease term is shortened. You thought the contract will end in FY29, now it's ending in FY24. Or the number of assets is reduced. So instead of 5 RICO copiers, you have now 3. So at lease termination, a lessee should account for a partial or full lease termination by reducing the carrying value of the leased asset and lease liability and recognizing a gain or loss for the difference. The excess difference is the difference between the accumulated amortization and the carrying value or the book value of the leased asset. A few things to note here is that the entries for step 13 have slightly changed. We removed some of the entries, so this is updated, not on our website yet, but it will be shortly. And also note that if you're making entries at the end of a lease and not terminating it prior to the end of the lease term, you would ignore steps 12A and 13. A lessor should account for the partial or full lease termination by reducing the carrying value of the lease receivable and related deferred inflow of resources and recognize a gain or loss for the difference, if any. So now for the resources, we have the GASB statement number 87, which can be found on the GASB website, as well as their implementation guide. Then on the GFOA website, they have a few resources. One is a GFOA leases tool for an example of how governments can perform the basic calculations for applying the lease standard with existing technology. And they also have a leases implementation examples for pre-existing lease contracts. Lastly, I wanted to show everyone the updated entries, and they've been only updated slightly to show the applicable funds versus the measurement focus, which I know was confusing to some people. And this follows suit to GASB 96 beta entries as well. Here's the lessee part 2, lessor part 1, and lessor part 2. All right, thank you. Up next is Brady with GASB 87, 94, 96 highlights.
Hello again. As I'm sure you all remember from the previous training, my name is Brady Stutzman, and I am once again discussing GASB 96 and 94, SPIDAs and P3s. Just had some highlights and some recaps for you based on some questions that we received and some other requests. So getting right into it, the first thing I want to discuss was the prepaid entry that we talked about in the previous training. The standard indicated previous payments as prepayments. So we read that as a prepaid item. It seemed odd at the time, but they characterized it as a prepayment. In the end, through a GASB inquiry and discussion with GASB staff, they indicated that they should be treated actually as construction in process, or CIP, rather than prepaids. So here is the original entry that we provided to you all. The next slide here is actually the corrected entry that you should be using going forward. So I want to put this up here and kind of go over it real quick just to show exactly what should be happening. First thing you would do is establish the CIP, or construction process, from an expenditure, a previous expenditure. So in order to do that, you would debit construction in progress, the 0861 using T code 545 or 555 if you're fiduciary. And then you would credit the gap expenditure offset. Moving down to step 2, you would then recognize the SPIDA asset and remove the CIP once it is placed in service. So to do that, you would debit 0819, the subscription-based IT asset, and credit the CIP, which was established in step 1. Keep in mind that this is only taking place in the government-wide, not the governmental fund itself, and so it would only be in the government-wide and proprietary and fiduciary funds. Moving forward, we received some requests because we had a decision tree for GASB 87 for leases, and also I created a decision tree for GASB 94 with the P3s. We got some requests for a SPIDA decision tree as well. And so I'll just go over that real quick. As you can see here, I'll just take us down the route that would get us to a SPIDA. The other option would simply be expensing it if you're taking the other option. So first off, we would ask ourselves, is the agreement excluded from the scope of GASB 96? If the answer is no, then does the agreement grant perpetual license or title? If it does not, then you'd ask yourself, do you have control? Moving on down, if you do have control, is the non-cancelable term greater than 12 months? If it is, then does the agreement have any fixed or fixed in substance payments? If you do, are the payments significantly lower than the market rate? If it is not, does the fair value of the SPIDA asset exceed the capitalization threshold of 5,000? If it does, then you would calculate the SPIDA asset and SPIDA liability. The answer is the opposite to any of those, then, as I mentioned before, you would record an expense and move on. Wouldn't worry about SPIDA. So the next question we got was, is the prior period adjustment necessary for contracts occurring prior to 7/1/22 implementation date that have not been recorded as a prepayment? The answer is these should be accounted for as a change in accounting principle, which is GL 3064, not a prior period adjustment, GL 3060. GL 3060 is for corrections of an error, but the prior treatment of these was not contrary to GAAP, so it was not an error at the time. Therefore, we would opt to use the change in accounting principle, GL 3064. Next question we received is, do we need to capture the prior period expenditures made for SPIDAs prior to 7/1/22? The answer is, if you would like to go back to the beginning of SPIDA implementation expenses that were spent prior to 7/1/22, the standard allows for this, but does not require it. So this would be up to your agency on if they find value in calculating the full amount or not. Totally up to you. And feel free to reach out to us if you feel it is necessary, you know, depending on if you believe it's significant and everything like that. I took this slide from the previous training. It's just the key takeaways from the SPIDAs. If you have any questions on any of this, I mean, feel free to ask us, but also refer back to the previous training and to get more information on it. But first off, always consider materiality. Start with the big ones, and always remember, you know, the capitalization threshold is 5,000. If it's less than that, don't even worry about it. Be mindful of the short-term exception. You may need to talk with your IT department, leadership, procurement, etc., to determine any potential SPIDAs that you may not have thought of. Also review accounting records for payments for potential SPIDAs that you didn't think of. For pre-existing SPIDAs, measurement should be reflective of the transition period, which is 7/1/22. As I mentioned in the previous training, future payments should be discounted at the rate charged by the vendor or the incremental borrowing rate of Oregon Bond Index. I won't go too much into this, but I did put the link here because we went through it pretty in depth on the previous training, so refer back to there if you need to. Obviously select the rate that most closely matches the effective date and term, and then, as always, document your due diligence along with the rate that you used and how you got there. Finally, Valia stole my thunder with this last one, but just wanted to remind you all to establish a new D23 fund and have it point to GAAP Fund 0054 if you do not have the ability to record revenue in GAAP Fund 0001. Okay, I believe that's it for SPIDAs. Moving on to P3s now with GASB 94. Previously, we sent out a survey to all of you and asked that you complete it. If you have not completed it and would still like to, then we'll gladly accept it, but definitely not necessary. It's totally up to you. We received 41 responses back, and only 2 of them came back saying they have P3s. So that's the extent of the exposure. Also wanted to mention that these surveys are not binding. So if you indicated that your agency has no P3s, we will have disclosures for P3s that you will need to complete. So we will use those for the ACFR and not the surveys. But so it's also kind of a good thing because, I mean, if you indicated that you don't have a P3 in the survey, but then eventually you realize that you do, not a big deal. Just update the disclosure as you actually do and go from there. This slide looks similar to the SPIDA key takeaway slide. Again, I took this from the previous training, so refer back to there if you have any other questions. But a couple distinguishing factors here. So obviously the same capitalization threshold is 5,000. So consider materiality when going through those. Talk with leadership, procurement, and intergovernmental staff to determine any potential P3s you haven't thought of. Review your accounting records for any potential P3s. For pre-existing P3s, they should be recorded as if they were measured as of 7/1/22. And then I won't go into the Oregon Bond Index and rates again because I just discussed that a minute ago. Finally, if you have any questions, feel free to review the slides of the previous training, look at the entries, check out the decision trees. We should have the decision tree uploaded to the website for SPIDAs. The other ones already are. Contact your SARS analyst, consult the OIM, which should be done soon. and also read the standard if you would like some nice reading material before bed. And that is it for me. Let me know if you have any questions, but next is Rob.
Hamilton again. I am back to cover what's coming from the GASB. You'll see the theme for the slides on this section look like a little bit of a crystal ball. I thought that was appropriate since we're covering GASB standards that are not only issued but not yet effective, but also things that might be effective. And they're just currently on the technical agenda for the GASB, but things that might be coming our way. So we'll start off with standards that have been issued but are not yet effective. GASB statement number 99, Omnibus 2022. This has multiple effective dates, including some that are effective for 2023 pertaining to leases, P3s, and SPIDAs. I'll get back to those in a moment. For fiscal year 2024, there are topics that are going to cover financial guarantees and derivative instrument reporting. GASB statement number 100 is also effective in 2024. That's going to cover accounting changes and error corrections, provides greater clarity around what should be considered an error for a prior period adjustment, or whether something is a change in accounting principle or is a change in accounting estimate. And then we're going to follow that up in 2025 with GASB statement 101, which is compensated absences. The nice thing about GASB statement number 101, we no longer need to separately report increases and decreases in compensated absences. However, we will now begin to report sick leave as it pertains to state agencies. There's no longer an exception for non-vested leave, which would previously was sick leave. Jumping back to GASB statement number 99 and the piece that's pertaining to leases, P3s, and SPIDAs. In my opinion, these are largely clarifications, and I wanted to highlight those. The first one is an option to terminate a lease or a SPIDA or a P3 is an unconditional right that exists within the contract. Provisions that allow for the termination of the arrangements due to the violation of lease terms or and conditions, such as default on payments, are not considered options to terminate. I don't think this is a major sticking point for agencies based on the conversations that we've had, but again, since it isn't a standard, I want to address it. The next one is, and this would apply only to SPIDAs and leases that have those short-term exceptions. And in a scenario in which an arrangement has been previously determined to be short-term and has been modified to extend the initial maximum possible term under the contract, should be reassessed from inception of the arrangement. Therefore, if the reassessed maximum possible term is greater than 12 months, the term should no longer be considered a short-term arrangement. And then for an arrangement that is reclassified from a short-term arrangement, that the term should be reassessed beginning at the date of the modification for purposes of measuring the receivable or liability. So again, this is not a renewal. This is not. This would only be in those scenarios in which the arrangement has been modified. That would apply to leases and SPIDAs. I think what the objective here is to not incentivize governments from entering into what would otherwise be a short-term SPIDA or short-term lease, and then modifying it so that it now extends beyond the 12-month limit, and then not requiring those governments to account for those arrangements as if they were otherwise eligible or otherwise subject to GASB 87 and GASB 96. So is there something to be on your radar? Again, I don't know that this is going to be a major practice issue for us, but it is in the standard, so I wanted to address it. Future standards. So these are the things that I do think are they're currently on the technical plan for the GASB. I think we're going to have something on these in the near future, and I've got the dates that are going to address some of these things. So risks and uncertainties disclosures. The final standard is expected to be issued here in the upcoming quarter. Thankfully, this is a note disclosure item and is expected to have limited impact on states. Classification of non-financial assets and exposure draft is also expected soon. This really is providing some, in their words, tweaks to existing guidance for things like assets held for sale. And again, the focus is a note disclosure, not a recognition, so nothing on SFMA. Financial reporting model and the revenue and expense recognition. Both of these are major standards that are going to have, I think, far-reaching impact on how we do accounting and financial reporting for governments. For the financial reporting model, a final standard is expected in the first quarter of next year. What the effective date of that standard will be, it will remain to be seen. I would expect it's going to be a bit of a long runway just to allow governments to properly implement the standard. Revenue and expense recognition, there's an exposure draft that's expected, and you can see here in 2025. So this is a little bit further out with the final standard not expected until the second quarter of 2027. And this is moving from an exchange, non-exchange focus to a performance obligation, non-performance obligation. Going concern, uncertainties, and severe financial stress and infrastructure assets. These are not as far down as the topics that we just covered on the previous slide. With respect to going concern, uncertainties, and severe financial stress, an invitation to comment is expected in next summer, with the final standard expected in the second quarter of 2027. It's really focusing on what are the proper disclosure elements when a government is in severe financial stress, in part because going concern is really uncommon for governments. They don't typically go out of they don't typically go out of business like we see in for-profits and non-for-profits. So it's modifying the guidance to be appropriate for the government environment, because I think, as we all can recognize, governments do encounter severe financial stress, and it's looking to provide some clarity on what should be included as we are as governments face those. Now, I don't think, knock on wood, that this is going to be an issue for states, but perhaps as we're engaging with other governments, it's something to be aware of. Infrastructure assets, this has been recently added to the technical agenda by the GASB, I think in the last 3 months. There's going to be an invitation to comment next summer, with the final standard expected again in the second quarter of 2027. I don't know if you're picking up a theme. They anticipate being busy in that second quarter of 2027. So whether that means you want to plan your retirement around that, it might be a wise decision. So the recognition of infrastructure assets and whether or not to use the modified approach, or whether it should even be allowed, is one of the areas that they're going to focus on. This is really early in the stages of this project, so I think everything is exploratory at this point. And if you are hearing things just as part of your normal interaction with colleagues that, oh, they're going to push us into the modified approach, which Oregon does not use, the GASB is doing this, I think it's really too early to tell. It's right now, it's just starting a project with there's a lot of federal money that's coming for infrastructure. It's on the asset side, it's certainly our largest asset, as a whole. So I think a lot of our users are really interested in, are the reporting elements of capital assets and infrastructure in particular, are they sufficient? And then also they're going to consider whether additional information related to necessary maintenance and preservation of infrastructure assets needs to be either recognized or disclosed. So potential GASB projects, these are some things that they're either considering. You can see here I've got some research activities and monitoring activities, which are different elements for the GASB technical plan. But this just gives you, I think, a bit of an indication on where things may go in the future. Currently, that's not to say this is the complete list of what might be coming, but I think it's to say that these are the areas that are on their radar that might ultimately develop in a standard. So I'm not going to read through all of them. I'll just go through a couple of highlights: distributed water management programs, environmental credits, in-kind contributions and services, popular reporting, present value, revenue recognition for gaming activities, and Social Security disclosures. Those are, again, some things that we might see in the future. Research activities is subsequent events. That's, I think, to say that they're looking into it, and there's not an active project. It's just something that they are doing some research on. And then I think even further away from being a standard, it would be monitoring activities. And this might just be some things around, does GASB have a role in this in some way, shape, or form? And those are covering digital assets. So think of your cryptocurrencies, particularly in an environment where governments are accepting cryptocurrencies for payment, not necessarily that they're investing in cryptocurrencies. And then also electronic financial reporting, and then ESG reporting, which is environmental, social, and governance reporting. I sent an email around this on the Act for Context News a little bit ago, but I think it's worthy of bringing up here as well. GARS, Governmental Accounting Research System, that is GASB's, it's effectively the complete codification of which the codification is really the most up-to-date version of a topic. So GARS has each individual standard. So if you want to look at a specific standard and it has a basis for conclusions and some background, it has that. If you're looking for an implementation guide, which covers questions and answers, it has that. Again, the codification, which is really searches by topic. So if you wanted to look at liabilities, there is a chapter in the codification that covers all the currently effective standards. The reason I like the codification is there are certain scenarios where a standard has been superseded or has been amended by a later standard. A great example would be statement number 60 covering service concession arrangements has been superseded by GASB statement number 94, which is the public-public and public-private partnerships standard that we're all implementing this year. So we get the updated guidance in the codification. That codification incorporates the most up-to-date guidance along with the implementation guidance questions. So you can read through a relevant topic, and then as you can go down, you can see the questions and answers. So I really like that codification. But just I think the takeaway that I have for you is it's free to use, and the website is gars.gasb.org. That's what is our primary go-to resource whenever we're performing research. So wanted to bring it up here and just encourage people to take advantage of this. It's a really good tool. So again, questions. I recognize we don't have the opportunity to answer questions, but I hope you found this section informative. And now we're going to move on to the disclosure topic with Barbara Homewood.
Homewood, and I'm going to go over what's new, what's changed, and some common errors when filling out disclosures. I'm going to start with information that applies to multiple disclosures, then go over a few new disclosures, and then proceed in alphanumerical order. There are times when one realizes after the close of month 13 that there was an error in an entry that would have reclassed from non-current to current, for instance, and you can't go back and correct it, but you know that the amount on the 6620 screen is incorrect. What do? Well, you do put what the amount should have been on this disclosure, and then either put something in the dialog box on the disclosure describing why the two are different, or in the submission email. Now, one thing to emphasize here is that this isn't a get out of jail free card. Accuracy is still a gold star criteria. Thus, if at all possible, utilize the soft close balances to check while starting disclosures during hard close week. That way, if you do run across this, there is still time to make the correction in R-stars. There are a handful of disclosures that use a cross formula where it takes the beginning balance plus increases less decreases and calculates an ending balance. And you'll see here the column for ending balance is green. That indicates that's where the formula is, and you cannot enter an amount there. So a few things to point out is do not net. Present increases and decreases separately. Another thing on the very far left is a column called Gap Fund, and on the far right, Liquidating Gap Fund. I need to stress that the Liquidating Gap Fund can never be 8,500. So please don't put that there. If you do, you're going to get it back and ask for a correction. Now, if the Gap Fund on the left is 8,500, then the Liquidating Gap Fund will be a governmental fund. If the Gap Fund is internal service, the Liquidating Gap Fund will be internal service, and likewise, if the Gap Fund is fiduciary, the Liquidating Gap Fund will be fiduciary. Now, the amount due in 1 year will be a credit balance, and I say that because, well, I'll say most of the time will be a credit balance, because most of these that have these cross formulas are for liability balances. The one exception that I'm aware of right now is on a debt disclosure form for GL 1000, deferred outflows, loss on debt refunding. That will be a debit balance. Now, another common error is when folks look at their 6620s and see a zero balance for a particular GL account that would be listed here, and they say, oh, I don't need to fill it out. That is not necessarily true. If you had a beginning balance at the beginning of the fiscal year 23 and it came zero during the year, you still fill this out with the beginning balance and the decrease in a zero ending balance. Here are the three new disclosures. They all relate to GASB's 96 and 94. And we don't have them available yet to show you, but General Disclosure 34 for SABITAs will be similar to the General Disclosure 10 for leases. And information for service concession arrangements, which was F in the previous year, will now be presented in Disclosures 35 and 36, which are new this year. As I just mentioned, we no longer have F as service concession arrangements, and to save a lot of time of not relettering everything, we just took what was L last year and slotted it into F, which is now a certain asset, and it should read retirement obligations, and we'll be fixing that for the future. So General Disclosure 2, a lot of changes on this one. We've removed the column for the D23 fund. Now the information will be disclosed by GAP fund and by GL account. We have added two GL accounts, 0250 for investments other and 0255 for investment valuation account other. They're added to the drop-down list in the GL account column. The amounts, there's a second column, there's now two columns, as you can see, for current and non-current amount. That used to be a drop-down. They will total at the bottom of this page, and if you need more, they're on the additional tab. The totals from this tab will start the next one, and the additional tab does total as well for a grand total. So General Disclosure 8, what we need to emphasize here is that any right to use capital asset, which is leases or SABITAs, will need to be listed in the section called debt related to fully completed projects. That's because we don't expect anyone to lease a partially completed asset, so they will go there. Now the amounts for the leases listed here by GL should agree to the amounts listed on Disclosure 10, tab 10E by GL account. And what's next is that tab, here's tab 10E for leases. And so the part that would go in amount listed in for year ending 2024 should agree to the amount listed in GL 1281, which is leases, the lease liability current. The amounts listed in 2025 through the 2068 should agree with the amount in GL 1716. And as I already said, the two amounts listed here should agree to the GL's amounts on Disclosure 8. And also, there'll be General Disclosure 34, tab 34E will be used for SABITAs in the same fashion. General Disclosure 15, what really has changed here is we've added two lines to come up with an adjusted beginning balance. We do want balance in GL account 3037 beginning of fiscal year with the two asterisks to be what is on the 6620 screen. Post-close adjustment and adjusted beginning balance. Now, every year there are a handful of agencies that record a post-close adjustment to non-current receivables. Often the beginning balance that would not include the post-close adjustment, which would require research by the Government-Wide Reporting Fund compiler. And so this is what's driving this change. This year there will be 8 agencies that will need to do this, and I am planning to send agencies an email the Monday after year-end closing, letting them know what the beginning balance should be, or in this case, the adjusted beginning balance, the amount of the adjustment, and the reason for the adjustment. On general disclosure 27 for significant interfund transfers, as we can see here that some criteria to apply, all of them exceeding $1 million. But on letter A, the operative phrase is do not occur on a regular basis. So if, for example, a transfer is made quarterly or annually, that is considered a routine basis, and thus do not report on this transfer on here. Continuing with letter A, at the very end, notice the conjunction is or and not and. And for letter B, the phrase are consistent with the activities of the fund making the transfer is the key word is inconsistent. And they offer an example here of a transfer from a capital projects fund to the general fund. Another example would be a general fund sweep. Lastly, if the qualifying transfers are within the same gap fund, they are not to be reported. Now, in order to determine that, there needs to be communication between the agencies to know whether or not this one applies. So general disclosure 30 for the outstanding balances with component units, the disclosure does say about a little further down than half, the bolded and underlined, the disclosure pertains to balances of $100,000 or more, with 3 exceptions. Now, I want to clarify that this means $100,000 or more per component unit, not in total for the GL balance. And again, with the exceptions noted on the form there. For instance, if an agency has a due from OHSU for $50,000 and a due from Portland State University for $60,000, neither one of them would be reported on GL 0857 on this disclosure form. However, each would be recorded as an accounts receivable. Now on general disclosure 33 for other receivables, the only change here is that we removed the word non-current from other receivables. In some agencies, when they had non-current receivable balances, they would think, well, this is the only one that says non-current, so I'll put it here. And that wasn't what we were intending. We were intending that if you had a non-current, say, interest receivable, it would still be posted to interest receivable. So only use the other receivables if one of the other categories does not suffice. And are there any questions? None. Okay. Well, this is likely my last presentation, as I plan to retire on February 1st of next year. I see that I have some old coworkers out in the audience and many colleagues, and it's been great working with those I have called a coworker or colleague over the last 30+ years. As a result of all of this, I have learned a lot, and thank you so much.
Rob Hamilton again here with the key takeaways, our final section of the FY23 year-end close training. Thank you so much for being with us. These next areas we're just going to cover, which we think are the key takeaways for the various training topics that we've covered so far today. For the year-end schedule, just to stay mindful of the upcoming communication and submission dates, both Gold Star and otherwise. Please don't forget to review items that may have been done in previous years, and when in doubt, call your SARS or SFMS analyst. With budgetary reporting, financial statements follow GAAP, whereas budgetary accounting follows the state's budgetary policies, and they do not always align. And then don't forget OAM 20.30.00 PO and PR is the OAM that covers when an expenditure should be reported for the biennium. So if you're getting questions, which I imagine some of you are right now, around can the expenditure be recorded in AY23 or does it need to be in AY25, that OAM is going to be a great resource. For the considerations when accounting for federal awards, with advanced grants, be sure to review the unearned revenue and prepaid expense amounts for accuracy. Don't forget that $20 million threshold when moving federal awards between agencies or gap funds. And then when it comes to reporting FEMA on the CFA, a CFA corrections form is going to be needed because FEMA is reported as the reimbursement occurs, not when the expenditure occurs. With respect to changes in CFA submissions, remember to submit OB Excel reports as a workbook with tabs for each report. Be sure to fully populate subrecipient information in SFMA for accurate reporting and to minimize avoidable corrections. And then when there are SEVA corrections, all columns should be completed on the correcting entry if the information applies. So if that information was on the original entry, it also needs to be on the correcting entry. This with respect to the GASB 87 recap. Remember, lease remeasurement occurs when a lessee or lessor exercise existing options to extend or terminate, and the impact to the liability is significant. That is really the key word there. And then some things to consider now that we're in year 2 of GASB 87. Lease modifications are changes that increase the leased asset, and lease terminations are those that decrease the leased asset. With the GASB 94-96 highlights that Brady led, the takeaways we have for you there are SPIDA prepayments are reported as CIP in the government-wide reporting fund, proprietary fund, and fiduciary funds as applicable to you and your activity. With implementation, measure pre-existing SPIDA obligations as of July 1st, 2022. Don't go back before then and when you're trying to determine what the liability is. And then don't forget with GASB statement with GASB statement number 96 and 94, if you need to record the initial entries for those for which the general fund it makes the payments and you do not have the ability to recognize revenue in that general fund, set up a D23 fund that points to GAP Fund 0054. For what's coming from the GASB after fiscal year 2023, we get a bit of a reprieve from the systemic accounting changes. It doesn't last long, but we'll take the break when we can get it. With fiscal year 2024, standards to implement are including financial guarantees, derivative instrument reporting, accounting changes, and error corrections. And then major accounting standards are expected for the end of the decade. And then with respect to disclosure changes and common deficiencies, there are new disclosures for SPIDAs and P3s, so be on the lookout for those. And then disclosures should be the correct amounts, even if they do not agree to our SARS. And in that scenario, please be sure to notify your SARS analyst. Well, we are looking forward to a great year end, and that concludes our training. Thank you so much for listening in, and don't forget, please be sure to email your SARS analyst that you have viewed this entire training by close of business on Friday, June 30th. That is a gold star date. Thanks, everyone.